Eric Mwathe here with a continuation on the Divergence 2.0 and the Uniformity video. So let's begin here by recapping what we've learned so far. And it is that when an instrument moves to fresh 52-week highs and yet the RSI does not touch 61.8, then this becomes very bearish. Okay? Also, on the other hand, when an instrument makes fresh 52-week highs in price and yet the RSI does not trade as high as 69.10, that's bearish. But this is the most bearish here. On the other hand, when an instrument moves to fresh 52-week lows and the RSI does not touch 38.2, then this becomes a bullish setup. In fact, very bullish. When an instrument moves to fresh 52-week lows without the RSI touching 30.90, this tends to be bullish, but is not as bullish as the previous setup. The RSI did not go below 38.2. So this is the most bullish, and this is just bullish. And also let's go on to the idea that uniformity supersedes any type of divergence. In other words, if you understand the concept of uniformity here, then it almost supersedes your understanding of the much used divergences, either positive or negative. So let's take a look at some charts here. Let's begin by taking a look at a weekly chart for the IYR real estate market. And what I want to talk about here is the idea that you can see on this chart about in 2011, which is this time period here, we had the stock making a higher high in price, it's a green, this here, and yet you got the technicals making lower lows, and this lower lows happen to be at a level of about 61.8. So this level here is at about 61.8. So that was very bearish on a weekly chart, which might explain this pullback here. All right, this pullback comes because of this negative divergence here. Now, this was significant enough to change the direction of the 10-week moving average. You can see here, 10-week moving average changes direction, which means that this was significant for the stock. So what you do is you just keep this line where it broke down here on your charts. Just don't delete the line, because it's going to tell you where you can have some movement in the stock. In this example, you can see that eventually there would be resistance here, which happened to be this short-term high. So if you are looking for short-term moves in the market, that's a place where you can go short. There was another situation here where we touched that line, uniform action above the line and back below it. So this was a high. Now notice what happens is once we moved above this line here, beginning of 2013, we got this move from around here, and we had a nice move taking the stock to new highs here. All right, so that line, this line here in blue, is important to this stock. And you notice what happens is once we broke down here, ever since then, this has been almost a straight shot to the downside, because it broke below that blue line. And so this has been down since then, ever since we broke down here. Now, if uniformity is not a concept you understand, take a look at this. Other way to look at this is, so now we come and break this trend line here, this line that I'm drawing now, that line, and notice the uniform action that is popping up. Take note of, we seem to be bouncing on this line precisely, touching it with uniform action and bouncing above it, just like we touched it here with uniform action and back above it. But now notice what has happened since we broke down. We've come below this line, bounced off that line, went above it, below it. So that was a sell point there, which happens to be this high. We came above the blue line here, uniform action above the line and back below it, which is this short-term high, and a nice entry point. And again, you see recently we've gone above the line and back below it. So this, as of right now, seems to be where you want to go short. Now, I want to extend this line because this line actually goes back to 2009. This is a weekly chart for the IYR. So take a look at this chart now, which shows the IYR going back to 2009, 2008. So this line is important for the stock, and you can see it's been support during the time when the stock was on a move to the upside. But now, over the last couple of months, this has become backtest resistance and failure, and the stock or ETF is telling you when this is a short. Okay, now what's really interesting is if you use the RSI based on the way I look at it, is if you draw this blue line now, maybe I should change colors. Let me change colors so I don't confuse you. I'm going to draw red because it's already in red. Give me a second here. All right, so this line here. Okay, now what's really interesting is just by a simple line, this red line, is you can see that going back to late 2008, before this big crash action here, the stock had stalled right there. So once you identify that as a critical reversal point for the stock, all you have to do is draw a straight line, which is the red line, and every time you moved above it, since then it was a buy. It was a buy there, found support here with uniform action with this general area, eventually would bounce off here, bounced off here, which was this general area here, eventually recaptured it here, which is here, support here, which is here, support here, which is here. But what I want to show you is now what was support has turned into resistance. So we have to respect that. Resistance here, resistance here, resistance here, all that with uniform action. Now, let's move on to another idea here. So take a look at this one, and I know I pointed this one out on the last example, in the last video or the beginning or part one of this series. And if you draw a straight line here, you can see what's interesting is this is at a low. This point here is at about 61.8, so this is the most bearish formation, while on the weekly the price has made new highs. Okay, so I'm just showing you that it does, whenever you see this type of action where new highs come with the RSI stalling at 61.8, that's very bearish. And I believe even as of right now, this is a short, because it tells me more than likely we break down, and we break down here on the RSI too. So the market sometimes gives you very clear indications of what it wants to do if you understand the dance. Now let's take a look at the same chart from a closer view without all the annotations. So of course, if you are looking to go along this stock at some point, let me draw that. So this was a buy signal when it broke out here. What I wanted to point out by bringing this chart back is take a look at how this was uniform action. It went above this and almost back below it with uniform action, so that becomes uniformity. So that's a sell point there once the breakout fails. And take a look at how interesting is once you broke down here. So this becomes an important level. It's important because it changed the direction of the 10-week moving average. So this correction is significant to the stock. So that took place when this broke down here. Draw a straight line. And you can see that over many months we come back here, and this is uniform action. Back to the red line and back below it. So this becomes a sell point. That's what I wanted to discuss here. Also, don't forget the obvious here, which I pointed out, is new highs on a weekly closing basis, and yet the RSI was making lower lows and failing to hold above 61.8. This is the most powerful negative divergence you can find, because it does not move above 61.8 on the weekly at this time. Let's take a look at the chart for the NASDAQ here, and you see the NASDAQ again making higher highs sometime in January 2014, but you got lower lows on the technical. So let's bring the same NASDAQ chart here without the annotations, and you can see that coming into late 2013, early 2014, higher highs. Technicals did not move above 69.10. Actually, they were between 69.10 and 61.8. So in between those two numbers. But the takeaway here is higher highs with the second most powerful negative divergence being below 69.10, which might explain why gradually since then we've been creeping to the downside. I believe the magnitude of that formation here means that this is a serious high here. Already trading below the 50-day moving average could constitute a significant change in the sentiment. Let's take a look at another example here. And now around the same time period, the Dow Transports Daily, notice higher highs, January 2014, declining technicals, and this high here was well below 69.10, slightly above 61.8, but this is, let's call it the second most bearish negative divergence, which makes sense while we are pulling back. Now, if you use uniformity, then you can see that there was around this level here, for some reason this instrument seems to be stalling. Every time it hits these levels here, there's always some type of a pullback. Every time it comes back below that, we pull back, and you can see even most recently here shallow pullback, and now this negative divergence pullback tells me that this is a more serious variety pullback. We're already trading below the 50-day moving average, so this does constitute a break and also is a break of this trend line. So even if this was to rally, it needs to move above this green line. So this was support on the way up, this level here, and now the only way this market becomes bullish if this holds above this green level here, which it's not doing right now. Let's take a look at the S&P 500, and you see the same type of scenario here. We made an incremental higher high in price there, but the technical was well below where it should be, actually trading at about 61.8. So this level here is at about 61.8. So the S&P 500 gave us the most powerful bearish negative divergence, which would suggest to me that this move here is just the beginning of something that could end up being a major move in the market to the downside, just because of the magnitude of this bearish negative divergence there. Now, this is interesting because if you take a look at the S&P 500 on the hourly, we made a higher high on an hourly closing basis, but take a look at the difference of the RSI on the hourly for the S&P 500. This is actually trading even below this level here. When it made the high, is trading at about 61.8, if not below 61.8. So this higher high is absolutely bearish, which might explain why since then we've had this big move, because of the defect of this lower lows, which happens to be at below 61.8. Again, this just reaffirms what I've been saying about the different types of positive and negative divergence. That's what I'm saying. So let's take a look at the current market. So let's take a look at the current market just for the sake of understanding what I'm saying here. So now we seem to have made a slight lower low here in price, and the technicals have not gone below 30.90, and they've also now held above. So this level here, this little blip there with this low is holding above 38.2. You can see now at 41.66. On an hour-to-hour basis, it makes sense that the market might want to move higher because this lower low is consistent with a strong positive divergence. So you might get a move to the upside. The only problem is be careful if the market breaks down the RSI positive divergence line here. If it breaks that line to the downside, then that becomes a major entry point to the downside because it's a break. Does that make sense? So in other words, you're bouncing. If you bounce off the line, good. If you hold above that, good. But if the market breaks below that, then that becomes a very bearish sentiment development and the markets go lower. Right now, it looks decent for a short-term hour-to-hour bounce. Take a look at the Dow, and you can see now, this is where I want to show you uniformity. On this chart, you can see that the Dow made a high here, and this high was not followed by any negative divergence, right? Because there was not any other high here, so we can't say that there was negative divergence. But what I'm going to show you is the value of uniformity. This is what you do. You take the highs like that, and you can see that these highs connect you to this line connects you to this high, which was uniformity above the line and back below it, which gave you a short-term high. Again, the value of uniformity there. But take a look at this. While the Dow Transports, the Nasdaq, and the S&P 500 were giving you negative divergence, the Dow confirms the theory of uniformity, because here we went above it and back below this established line, and that was uniform action, which makes this a major high, which might explain why since then we've come down. Very simple reasoning. Again, I say that uniformity is very powerful if you understand it, because it tells you when something is happening in a stock or instrument that is actionable. So this here was uniformity, which told you that this was a trap. And now when you combine that with the action of the Dow Transport, S&P 500, and the Nasdaq, and especially the S&P 500 60-minute chart, you see that all this confluence, all this dance was saying that this was to be respected, which makes sense as of why since then we've been moving lower. Eric Moore, good luck, peace, and blessings. Mwah.